Can the ICICI Proof Gift Select Plan truly secure your loved one's future, or is there a better alternative? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So before analyzing this policy, let us first understand what is this policy is about. So ICICI Proof Gift Select Plan is a non-participating and non-linked individual savings insurance plan. Some of the key features of the policy are: you can leave a lasting legacy with the security of the life insurance coverage provided by the policy, and it ensures a steady income with guaranteed payouts starting from the first policy month. You also receive an immediate reward through the instant cashback benefit upon policy issuance. You can safeguard your savings from inflation with guaranteed income that grows annually when compounded, and you can maximize your earnings by opting for a lower life cover to enhance your guaranteed income. You can also enjoy flexible cash flow options, including the ability to accumulate income for future withdrawals. You can also optimize your tax savings, as the premiums are paid and benefits received may qualify for tax benefits under prevailing tax laws. Now, what are some of the benefits available in this policy? You have instant cashback benefit, where if you can opt to receive this benefit, which is a percentage of your annualized premium chosen by you on the policy inception. This benefit is only available if you have opted to pay premiums with a yearly premium payment frequency and receive guaranteed income annually with an income term starting from the second or later policy year. So this benefit is paid only once, and you will receive this benefit amount within 1 working day of the realization of the first year's premium. Another benefit is the guaranteed income benefit. So if the option of level guaranteed income has been chosen by you, you will receive a level guaranteed income from the chosen GI start date till the date of maturity, provided all your due premiums are paid and on survival of the policy holders on respective GI due dates. So this GI will remain constant during the entire income term. So if you start to receive income that increases every year, your guaranteed income payable starting from the chosen GI start date until the date of maturity will also increase every policy year at a rate of 5% per annum on a compounding basis. We also have maturity benefit, which is an option to receive a percentage of your sum of your annualized premium under the policy as a lump sum benefit on the date of maturity. So you need to select this benefit at policy inception to get it. So these are some of the benefits of this policy. Now moving on, let us take a look at the advantages and disadvantages of investing in the policy. So the advantages are: you can opt for the low cover income booster to receive a higher guaranteed income by choosing a lower life cover, and policies with an annualized premium above 50,000 in this policy are eligible for an additional guaranteed income benefit. And with the Flexi Save option, you can choose to accumulate your accrued guaranteed income instead of receiving it during the income term, and you can also avail a loan option up to 80% of the surrender value when needed. So these are the advantages. Disadvantages are: your income benefit reduces the maturity benefit, requiring a trade-off between the two. The sum assured is insufficient and the returns are relatively low. These are some drawbacks that you need to be mindful about before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us now move on to the analysis part of the video. Because while these features may seem appealing, it is essential to evaluate whether the plan truly delivers value. So a key factor in this analysis is going to be the internal rate of return analysis of this policy. So let us assume, for calculation purpose, that a 35-year-old male purchases this policy with the income benefit duration of 11 years, maturity benefit is 100% money back, sum assured is 15 lakhs, premium paying term is 10 years, annualized premium is 1.5 lakhs, income type is level income, the payout starts at the end of the 10th year, and the guaranteed income is 1,22,295 rupees per year, and the maturity payout is 15 lakhs, which is paid with the last income installment. So the calculated IRR for this cash flow is 5.03%, which is significantly lower than the inflation rate. It's not even comparable to the rate of return you can get from a bank fixed deposit. It's lower than a bank's FD. So, over a 20-year investment horizon, return should ideally outpace inflation to maintain the purchasing power. However, with an internal rate of return of just 5%, this plan fails to achieve that, leading to real value erosion over time. So, would you consider locking in your money for 2 decades with returns that struggle to keep up with inflation? So, yeah, we will not consider that, right? So that's why we are going to compare this policy with alternative investment strategies by evaluating three key aspects like insurance cover, income benefit, and maturity benefit, all within the same annual premium of 1.5 lakhs. So we are going to utilize this premium by allocating it efficiently to get even better benefits compared to ICICI policy. So for life cover purpose, we are going to invest in a pure term life insurance policy with a 15 lakh sum assured, which is similar to the ICICI sum assured, which costs 12,400 rupees per annum for premium for a 20-year policy term. So in the earlier example, the premium paying term for the ICICI policy was 10 years, meaning that in the first 10 years here, after paying for life insurance, the remaining 1,37,600 rupees per year can be invested separately based on our risk tolerance. So depending on the risk tolerance, you can either invest in PPF or ELSS. For this comparison, as you are going to invest for a long term, we have opted for the ELSS mutual fund because it also has tax benefits, and if you take a look at its track record, you can also see that if you choose to invest in it for more than 7 to 10 years, it has even outperformed its average benchmark of 12% return in certain cases. So after 10 years, when redeeming the investment, capital gain tax will apply for the ELSS fund, which reducing the post-tax final maturity value to 25.54 lakh. If you want to know how this calculation has been done, you can see the ELSS tax calculation presented on a tabular column on the screen for your reference. This accumulated corpus is then invested in an instrument yielding 7%, allowing annual withdrawals similar to the ICICI policy, while also ensuring that the remaining funds are fully withdrawn at the end of the policy term to match the maturity benefit. So the outcome is, if you take a look at the annual withdrawal is 1.22 lakhs, which is same as the ICICI plan, where the final corpus value is 32.16 lakhs, which is double that of the ICICI policy. And if you take a look at the IRR of the pure term policy plus ELSS combination, you can see it comes around 8.10%, which is significantly higher than the 5.03% IRR of the ICICI policy. So the key advantages from this alternative strategy is the term insurance plus ELSS approach provides you with higher returns and greater flexibility. The accumulated corpus can be utilized as per your financial goals, and in a rising interest rate scenario, you can shift investments or reallocate funds. So in contrast, the ICICI policy locks your funds, forcing you to settle for its structured income benefit. So would you rather settle for lower returns with restrictions or opt for an alternative strategy that offers better growth and complete control over your money? So what is the final verdict? Is investing in the ICICI Pro Gift Select plan worth investing or not? So this policy follows a simple structure. You pay premiums during the initial years and later receive benefits in the form of regular income. So while the plan offers customization in income and maturity benefits, the wide range of choices including premium amount and payment term, income period, policy term, guaranteed income option, and maturity benefit percentage can sometimes overwhelm investors, leading to suboptimal decisions. Beyond its flexibility, this remains a traditional insurance plan where you must trade off between regular income and a lump sum maturity benefit. The returns are subpar and the sum assured is inadequate, making this plan unsuitable for both your investment and insurance needs. And it also has a high agent commission. So instead of locking funds in a low return plan, build a diversified investment portfolio based on your risk profile, life goals, and investment horizon. For financial security, ensure you have adequate life coverage, through a pure term insurance policy. Being an informed investor means analyzing financial products carefully before committing. So, if you need professional guidance, consider consulting with a certified financial planner who can help you create a personalized financial plan tailored to your unique financial needs.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.